Now, starting with part 3 of these amendments and circulars, we are looking at amendments in business and profession. I am definitely expecting a question on this in the papers, so I'm going to take you, even if we've discussed this in the lectures, I'm going to take you through a summarized, through the summarized amendments, and of course ICDS. Now, there's been a lot of discussion of income disclosure standards. Now, children, I believe it is more hue than substance in this ICDS. ICDS कुछ नहीं है, we've already done all the concepts. Most of them are exactly how we've discussed them. The only difference is, earlier these disclosures were, or the treatments were as per case study. Now we have standardized standards. Now we have accounting standards as well. We have income disclosure standards as well. So do accounting standards influence ICDS? Yes, they do. But are accounting standards applicable on income tax? No. While computing total income, now do we follow ICDS? Yes. Have we been following ICDS already? Well, technically we have, because most of the concepts we do in ICDS are similar to what we've done. How elaborately should one do ICDS for the May 16? Now that's the relevant question. When I look at the supplementary module, it's a new topic, and whenever there's a new topic, you will never get a very elaborate 16-mark question. I'm only expecting a question maximum 4 to 8 marks, 4 marks ideally. Now, what we're going to do is we're going to look at each of the ICDS, all the standards, what they essentially say in a summarized manner. ICAI divides it into summary of ICDS, 3 parts. One is summary of ICDS, the other is the text, that is the detailing of ICDS, and then is the comparison of accounting standards, case study and ICDS. This for the moment is irrelevant for us. We want to look at this and this, and I believe there will be one question from here, and definitely there will be one question from here, so we are going to look at that. So let's start with the first part, the amendments in business and profession regarding something called additional, or something called depreciation, and let's also look at additional depreciation. We know that we make a block of assets and we add actual cost of assets that are acquired during the year. What we get is cost of block. Then of course there is money receivable for assets sold, discarded, demolished or destroyed, and I get value of block, and value of block into rate is depreciation. Now all this remains exactly the same, there is no change. The change is, when we had an asset which was used for less than 180 days during the previous year, then on the cost of that asset we add half the rate of depreciation. So we say, if an asset is acquired on, let's say 1st March 16, let's say for 20 lakhs, or let's take a bigger figure, we say 200 lakhs. So 200 lakhs into, now the rate of depreciation will be ready, if this is a block of plant and machinery, 15%, so normal depreciation will go down to 200 lakhs into 7.5%. So into 7.5%, which makes it 15 lakhs. Similarly, if this is a manufacturer and this is new plant and machinery eligible for additional depreciation, then on 200 lakhs, the rate of additional depreciation would reduce from 20% to 10%. That makes it 20 lakhs. So 35 lakhs is what will be reduced from your business income under section 32. You will be getting a deduction of 35 lakhs. Now if I look at it technically in the form of cash flow, or cash outflow, my profits are reducing by 35 lakhs and my tax will get reduced by 30%. So 10 lakh 50,000 without taking cess into count, 30% से tax बच रहा है. So 10 lakh 50,000 is cash saving by investing 200 lakhs on 1316. That means using it for less than 180 days. Now, if I say it is used for more than or equal to 180 days, then this depreciation goes up to 15%. This goes up to 20%, which means now, let's have a look. This will be 30 lakhs of normal depreciation, 40 lakhs of additional depreciation, which means the deduction would then be 70 lakhs. And on 70 lakhs, if I save tax, because I'm getting a deduction, my profits are reduced, 21 lakhs is the cash saving. Now, people might actually feel that in the first year, they are getting normal depreciation of 7.5. In the next year, they will get 15%. So that is okay. But additional depreciation is there only for the first year, which means they are losing 10% of depreciation by way of additional depreciation if the asset is acquired and used for less than 180 days. So Finance Minister Jaitley during his budget speech said that because of this, there are companies that are postponing their investment to the next year so that they can get the benefit of that additional 10% because it is going to save their cash. I hope you are understanding. See, as a businessman, I am not interested. Depreciation is a deduction, yes. But out of 200 lakhs, that is my cash outflow in the machine, I am going to get a benefit of 21 lakhs of tax saving. So this machine is actually going to cost me 179. But if I am not getting this 21, I am going to get a benefit of only 10.5. Then this machine is going to cost me more. And we are only looking at 2 crores. What about 200 crores? Investment of 400 crores. All of that will actually make this 10% a lot material in my decision making now. So what Jaitley did was that this additional depreciation, that balance you did not get in the next year, now he says you can claim it in the next year. So that people buy the machine now, take 10% in the first year, even if it is used for less than 180 days, the balance they can get in the next year. So in this case, had he been using it for less than 180 days, he would have gotten deduction for 35 lakhs in the first year. So we say in the year, he got a deduction for 35 lakhs. Next year, we say the opening comes to 200 minus 35, 165. And on 165, there is no addition. The cost of block is 165. There is no, the value of block is 165. And then on that, there is a normal depreciation of 15% plus 10% of 200 lakhs. So 20 lakh rupees which he had not been able to claim last year can now be claimed as additional depreciation in the next year. That is one amendment. Okay, now let's look at the combined effect of the sections applicable to manufacturers. We've done that already. We have additional depreciation which is at a normal rate of 20%. We have additional depreciation for units which are set up in backward districts of Telangana, Andhra Pradesh, West Bengal and Bihar. There is a notification given in the RTP giving you the areas that have been notified. I don't think that is relevant for your paper. Don't waste your time. You just remember in notified backward areas, the rate of depreciation becomes 35%. Then we have 32 AD introduced from 15-16. And of course, there's the 32 AC we already had for 2 sections for what we call investment allowance. I think there should be a small question, maybe 2 to 4 marks on this in the paper. A combined effect, we will have to have a look. First of all, we know all these are available to plant and machinery. The plant and machinery must be new, it should not be second hand. The plant and machinery must be installed in the factory. It should not be a vehicle, ship or aircraft. It should not be one which is 100% rate of depreciation. It should not be installed in a residential accommodation or a guest house. So if all these conditions are fulfilled, you get additional depreciation of 20%, but if it's in the backward areas of these 4 states, then it is 35%. Then of course 32 AD. Now for these two, the conditions are the unit must be set up on or after 1/4/15 and the plant and machinery must be acquired and installed. एक point is important, again on or after 1/4/15. For these two, if you've claimed investment allowance under 32 AC or AD, then you must not sell within 5 years from the date of installation, else the deduction claimed by way of investment allowance will be reversed. There is no reversal in case of additional depreciation. Now, keeping all of this in mind, one additional condition you need to remember, AC is only available to a company. Second, the minimum investment must be at least 25 crores. There is no such condition in all the other sections. These are available to any person. Any person, but of course that person should be engaged in manufacture. The more the deduction by way of depreciation or investment allowance, remember the lesser is the profit. Lesser the profit, lesser the tax. Savings in the form of tax become cash saving, and if there is cash saving, the machinery will cost you lesser, so people will be encouraged to invest more. Now here is a small example. We say investment of 100 crore. Let's say in a backward area, in a notified backward district of Telangana. Now first and foremost, we get a normal depreciation. So 100 crore into 15% is normal depreciation on plant and machinery, so 15 CR. Then of course you have additional depreciation. Because it's in a notified backward area, 35% is what we get, 35 crore of deduction. Now 32 AD and 32 AC. Because it's in a notified backward area, you get a 15% investment allowance. Now assuming this assessee is a company, then you will also get 100 crore into 15%, which is equal to 15 CR. When I look at the block on which depreciation for the next year will be given, I will say 100 minus normal depreciation minus additional depreciation. So 50 CR is available for depreciation next year. These are not reduced from the block. Now in such a case, this company has gotten a benefit of 50 plus 30, 80 CR. Now 80 CR into 30%, 24 crore is saved by way of tax. So that machine which you spent 100 crore for is going to effectually cost you about 76 CR. So he's encouraging you. Then comes, if this assessee was not a company, then 32 AC would not be available, but all the others will be available. Similarly, if this assessee was a company, but the investment was only, let's say, 20 crore. So a company investing 20 crore, normal depreciation 20 into 15%, which is 3 crore. Additional depreciation 20 into 35%, which is 7 crore. 32 AD of 20 into 15%, which is equal to 3 crore is available, but this is not available even if the assessee is a company, because investment is less than 25 crore. So that I believe you need to remember, because this is a question that is there in the RTP. You must do that question. It's a simple question I've just discussed, that is question number 5. Now, page number 34 onwards, these are the points covered in the supplementary manual. Page 34, 35, 36, 37, 38, 39 gives you a few questions which you must do for practice, because the habit is on a new topic, if there's a question, I'm sure the point has been mentioned in one of these questions. Maybe the question will not come as such, but there will be points that have been stated here that can be a part of the main question asked in the paper. So you can go through these up till page number 40. Now on page 41, I think two very important points. One is point number E and point number F. Now you can mark these as important. We've done the amendments, trust me, we haven't left them. But I'm now going to tell you the kind of question I think can be framed. So point number E and point number F is what we are going to talk about, but we can do that after we've talked about ICDS. So we'll have to go to ICDS, which is now on page 46. We have the notification for ICDS. So I'm going to read that for the relevant part. You can keep underlining. First and foremost, under section 145, income chargeable under the head business and profession or income from other sources shall be computed in accordance with either the cash or mercantile system regularly employed by the assessee. Section 145(2) empowers the central government to notify in the official gazette from time to time income computation and disclosure standards to be followed by any class of assessees or in respect of any class of income. Accordingly, central government has, in exercise of the powers, notified the income computation and disclosure standards to be followed by all assessees following mercantile system of accounting for the purpose of computing income chargeable to tax under the head business and profession and income from other sources. This shall come into effect from 1st April 15 and shall apply for assessment year 16-17, which means previous year 15-16. All notified ICDS are applicable for computation of income chargeable under the head profits and gains and other sources, and not for the purpose of maintenance of books of accounts. These are not applicable for accounting. In the case of conflict between the provisions of the Income Tax Act and the notified ICDS, remember the provisions of the Act shall prevail to that extent. So this part you can mark. If there is a conflict, contradiction between the provisions of the Act and ICDS, obviously the Act shall remain. Now he says, for a better understanding of ICDS and their impact, the following given here are: one is the salient features, this is the summary. The text of ICDS, that is the details. Now I am assuming you've done your accounting standards properly. So I'm going to use or assume that you know your accounting standards, and I'm going to take the difference between the accounting standards and ICDS from the point of taxation angle and explain the kind of question I expect in the paper. So ICDS vis-a-vis the accounting standards and ICDS vis-a-vis the judicial rulings. This is very important, and this is from page number 83. Yeah, page number 83 of your supplementary. So this is very important. The summary is on page number 43. We're going to do that. The detailing, I am not going to go into details. You'll have to trust me on this a little. Now accounting policies is ICDS 1, and of course we know that ICDS 1 deals with significant accounting policies. One of the simplest accounting policies we know is a going concern, consistency and accrual. However, ICDS does not recognize the concepts of materiality and prudence in selection of accounting policies. We will go into the details. You know, accounting standards talk about prudence as well. So where there is a certain estimation of cost that you are incurring, you can take that into consideration while making your accounts. But in income tax, we follow the going concern, we follow consistency, we follow accrual method, but we do not recognize materiality and prudence. We'll take a look at what that means in just a little while. Treatment and presentation of transactions have to be governed by their substance and not the form. So now that is important. We are looking at the substance of the transaction, not the form of the transaction. Mark-to-market loss or an expected loss is not to be recognized unless recognition of such loss is in accordance with provisions of any other ICDS. Now this is nothing different from what we've discussed. In income tax, notional income is not considered, notional loss is not taken into consideration. That remains exactly the same. ICDS 2 talks about valuation of inventories. So from ICDS 1 accounting policies, what I would want you for the papers to remember is that it does not take into consideration the concept of materiality or prudence as AS does. Second, the loss, estimated, expected losses will not be recognized unless there is an ICDS that allows you to recognize such expected losses. We will talk about that. And the transactions will be treated as per the substance, the intent, not the form in which they are presented. So you will have to go beyond the form. Now, valuation of inventories. Well, inventories valuation cost will include not just the cost of raw material, work in progress, consumables, freight inwards, any taxes due on that. All that is a form or part of the costing that we do. He says the valuation of inventories have been defined to mean assets which are held for sale in the ordinary course of business. We are talking about stock, in the process of production for such sale, in the form of materials or supplies to be consumed in the production process or in the rendering of services. So all these valuations we will be given in ICDS 2. The ICDS requires inventory to be valued at, now this is important, we already know this, cost or net realizable value, whichever is less. So the cost or the net realizable value, which is the market value, less any expenses that are required to be incurred to sell that, which I believe you already know through your accounting standards. So ICDS requires disclosure of the accounting policies adopted in measuring inventories, including the cost formula used, the total carrying amount of inventories and its classification appropriate to a person. Now just to find out how we can be asked a question regarding this. So we say on page 82, there's a topic that says ICDS vis-a-vis the accounting standards, ICDS vis-a-vis the judicial rulings. He says there are significant deviations, there are significant differences between the notified ICDS and accounting standards which are likely to have the effect of advancing, preponing and recognition of income. Now, income tax is only concerned with the getting of tax. I'll give you a simple example, children. We talk about NPAs in banks. We talk about revenue recognition. Now, if a bank knows that an account is an NPA, should it take the interest into consideration as part of its income? Now, your accounting standards tell you that if there is a likelihood of the money not coming, you need not take that as part of income. But income tax says that interest should first be taken as part of income, and thereafter, once you do not receive it, you claim it as a bad debt, which actually means you are preponing the revenue recognition, and so collection of tax becomes higher now. Later, when you don't recover the money, you can claim it as bad debt. Now, we will talk about that when we do the ICDS on revenue recognition. So, I'm just trying to now look at the differences between accounts and income tax. So, income tax का एक basic logic क्या है? Preponing revenue, postponing expenditure. So, preponing revenue and postponing expenditure so that you have earlier collection of tax, and postponing the recognition of expenditure or losses under the tax laws and consequently impacting the computation of tax liability under the Income Tax Act. Now, these deviations would increase the timing differences between taxable income and accounting income. So, by now we are also used to the absolute, what should we say, differences in accounts and tax. So, as a chartered accountant, you are required to calculate accounting income for the investors and taxable income for the tax department, and we need to know the differences. Though I believe at some point of time these should have been actually coordinated well enough that these differences in the two acts do not remain, but that has not happened with ICDS. So a lot of experts will tell you that maybe the ICDS are only here to complicate matters more. So further, ICDS at many places differs significantly from decisions pronounced by Supreme Court and High Courts, and some of these are highlighted here under. Now, over time, in the next 2-3 years, a lot of discussion and debate will go on the ICDS, and I'm sure in the next 2 years, these will become a very integral part of the taxation paper. But for the moment, I believe the paper will come from here. So we look at accounting policies. We say accounting policies, while recognize the fundamental accounting assumptions of going concern, consistency and accrual, does not recognize concept of materiality and prudence. The concept of prudence requires that provisions should be made for all known liabilities and losses, even though the amount cannot be determined with certainty and represents only a best estimate in the light of available information. However, income tax does not recognize prudence. So we are not allowing you to have a policy where you can recognize expenditure where it is only an estimate. So non-consideration of prudence in selection and application of accounting policies may have the impact of earlier recognition of income. So you're not getting a deduction for expenditure, or later recognition of expense or losses for tax computation. Okay, when we do ICDS 7 on government grants, we will learn that government grants when received are not to be taken as income unless the client has undertaken to fulfill all the conditions with reasonable certainty. So you receive money, but you've yet not fulfilled the conditions, then you do not recognize it as revenue in accounts. What does ICDS say? Recognition of government grant shall not be postponed beyond the date of actual receipt, even if conditions attached to the grant are not fulfilled. Now, ICDS says that the moment you receive the money, even if you've not fulfilled conditions, you will recognize it as income, which is preponing income. So here's the difference between accounting standards and government grants under ICDS 7. The rest of the examples, as we do the ICDS, we will come to, but each of them. Requirement of reasonable cause for a change in accounting policy AS5 vis-a-vis ICDS. Now, Accounting Standard 5, which deals with changes in accounting policies, permits a change in accounting policies if adoption of a different accounting policy is required by a statute, by law, or for the purpose of compliance with an accounting standard, or if such change results in a more appropriate presentation of financial statements. So as per AS5, you can change your accounting policies in a few cases, but when we look at ICDS, it just leaves you somewhere in between hanging, saying that an accounting policy should not be changed without a reasonable cause. Now, who determines what reasonable cause is? So there is no mention of a change in accounting policy because of statute or any of the other points, but it just says reasonable cause. Now, reasonable cause has not been defined and would involve exercise of judgment by management and tax authorities. A clarification as to the meaning of scope of reasonable cause would help avoid litigation. ICAI is giving an analysis saying that because of that particular word, reasonable cause, we will have a problem in the coming years as to what will amount to a reasonable cause for change in accounting policy. Now, I want you to understand just the differences between AS and ICDS. So you could get a question saying, ICDS 1 talks about accounting policies for computing income under business and profession. Bring out the effect of ICDS 1 vis-a-vis the accounting standards. So we're going to write down 2 points, that the concept of prudence is not recognized. 1, we'll give an example of the government grant. Second, we will say that the change in accounting policy can only be done in ICDS once there is a reasonable cause which has not been defined, while in accounting standard 5, there are other cases where accounting policies can be changed. When we look at valuation of inventories, your AS2 prescribes a standard cost method for calculation of the valuation of inventories. Now, ICDS 2 on valuation of inventories only talks about first in, first out, or a weighted cost. Therefore, standard cost method is one of the techniques used by AS, but there is no enabling clause in IS2 permitting adoption of standard costing method. So that's one difference between AS and ICDS. Second, now this is the more important one, and when I was reading this, I was thinking that this is the question I would have asked in the paper. And when I looked at the RTP, there was a question based exactly on this. So, now, when we were doing assessment of firms, let me remind you of what topic we are talking about. When we were doing assessment of firms, we said that in case a firm is dissolved and the business of the firm is taken over by one of the partners without a discontinuance, and we laid a lot of stress on this case laws. There was a CIT versus Shakti Trading Supreme Court judgment which said that in such a case, the closing stock in the firm will be valued at cost, not the net realizable value. Now, because of ICDS 2 not giving this exception, it has overridden this case. Which means now, even when a firm is dissolved and the business is taken over by one of the partners without discontinuance, the closing stock will have to be valued at cost or net realizable value, whichever is less. So, let's have a look. In case of dissolution of partnership firm or AOP, paragraph 24 of ICDS 2 on valuation requires that inventory on the date of dissolution to be valued at net realizable value, notwithstanding whether the business is discontinued or not. This is in deviation of the Supreme Court ruling in Shakti Trading, whereas it was held that if a firm is dissolved due to the death of a partner and the surviving partners reconstitute the firm and continue the business as before, the firm is entitled to adopt cost or market price, whichever is lower. Now, that obviously has been overruled, and we will look at an RTP question on this. So, when we did the CIT versus Shakti Trading judgment, what it said was that in case the firm is dissolved because of a death of a partner and the business of the firm is carried on by one of the partners without discontinuance, then the closing stock can continue to be valued at cost or market price, whichever is less. So, the cost is 100 and the market price is 120, you can value the cost at 100, thus thereby reducing the profit that will be accessible to income tax. Now, with the ICDS, let's see what has happened. Now, this judgment has now been overruled because of a clause in the ICDS 2 which specifically talks about valuation of inventory on the date of dissolution to be valued at the net realizable value, notwithstanding whether the business is discontinued or not. So, ICDS 2 is a deviation from the Supreme Court ruling in Shakti Trading and Company, where it was held that if a firm is dissolved due to the death of a partner and the surviving partners reconstitute the firm and continue the business as before, the firm is entitled to adopt cost or market price, whichever is less. Now, that is over. So, from now on, this judgment will not be followed. Now, the closing stock will be valued at net realizable value as the business has now been stopped. So, thereby resulting in higher profit. So, like I was saying, the basic concept of ICDS being higher revenue recognition. More taxes, the government needs money to run the country. Now we come to, and this is okay, there was a question in the RTP based exactly on this. Message XYZ, a partnership firm, this is question number 12. Now just giving you the mindset of the examiner as to the type of questions he might raise in the paper. I am not saying exact. A firm was dissolved on 1/4/15. How is inventory on the date of dissolution of a firm to be valued, where the firm's business is to be continued by Mr. X, one of its partners? What was the manner in which such inventory would have been valued had the dissolution taken place on 31/1/15 instead of 1/4? Now here ICDS 2 was not applicable, therefore CIT versus Shakti Trading was applicable. And over here now ICDS 2 becomes applicable. So like I said, from page 83 onwards, the correlation given between ICDS and accounting standards and ICDS overruling certain judgments become probably the more important pages for you to read. That's why I'm doing each page with you. Okay, moving on. ICDS 3 talks about construction contracts. So we are back now to the summary. Construction contracts Well, you know, long-term contracts, we look at contracts over 3 years, 4 years. Accounting standards tell you how to value or when to recognize the income on such contracts. Now, there's a percentage of completion method, there's a survey method. What does ICDS follow? ICDS only recognizes the percentage of completion method, which I believe you already have done. I will not waste time going over it, but we all know total costs of the project and the proportionate cost up till date will determine the percentage of completion. And based on the total revenue, we apply the percentage of completion to find out how much is the revenue to be recognized in that particular period. Now that is what ICDS 2 recommends. So for recognizing contract revenue and contract costs associated with a construction contract. Then ICDS also contains certain disclosure requirements like the amount of contract revenue recognized as revenue in the period, the methods used to determine the stage of completion and the works in progress, which, as I said, we will not go into too much detail right now. Just remember that it recognizes only the percentage of completion method. Now, what is the difference between AS7 and ICDS 3? Recognition of expected losses on contracts. Sometimes during the execution of contract, the contractor might realize that his costs are likely to be more than the revenue, and based on that he can recognize his loss. So AS7 permits recognition of expected loss on construction contract as well as contract costs, recovery of which is not probable as an expense immediately. So you can immediately recognize that as part of your expense. It also permits recognition of expected loss immediately as an expense when it is probable that total contract costs will exceed the contract revenue. This you should already know. Now in ICDS 3, the absence of the specific requirement to recognize such expected losses on construction contracts immediately represents a significant deviation, as well as judicial rulings permitting immediate recognition of such losses as long as the same are in accordance with accounting standard. Now this is now overruled because ICDS now also says the losses for tax purposes, the recognition of losses for tax purposes will be postponed, which is in tune with the thought I just told you. The income will be higher. That is one. Then there are penalties a contractor might be liable to pay because of delay. So AS7 says it permits decrease in contract revenue as a result of penalties arising from delays caused by the contractor in the completion. However, ICDS does not permit such reduction, because of which if penalties are liable to arise, which are not going to be allowed as a deduction from revenue, which will again increase the income, thereby increasing the tax effect of inflating the taxable income and effectively the consequent tax liability. Retention money. You've read that whenever a contractor raises a bill as per terms of contract between the contractor and the client might retain some money out of that payment. AS7 says that retention money only becomes your income of the contractor once you are liable to receive it. So we say ICDS 3 requires retention money to be treated as part of contract revenue immediately and recognized on percentage of completion method. However, as per AS7, contract revenue should comprise the initial amount of revenue agreed in the contract. There is a specific requirement in paragraph 10 to include retentions. There is no such requirement in AS7. So retentions in AS7, as we said, can be treated as part of income when you are liable to receive them. Even in fact, in income tax, there is a judgment regarding this where it was held that payment of retention money in case of contract is dependent upon satisfactory completion of contract work. The right to receive retention money accrues only after obligations under the contract are fulfilled. See, the client will retain the money only because it is subject to the fulfillment of conditions and timely delivery by the contractor. So even in income tax, judges have said that please recognize retention money as income only when the obligation to receive it. Therefore, it would not amount to income in the year in which the amount is retained. However, this is now overruled. The ICDS says recognized retention money on percentage of completion method marks a significant deviation from the decisions pronounced by the courts. So these 2-3 points that we are doing, you must lay stress on the points that I am raising, because I do believe that there will be a question on one of these in the paper. Now we go to ICDS 4, and after this we'll take just a small break. Revenue recognition. Now revenue recognition in sale of goods, sale of services, and he says utilization of resources revenue. So if I am a trader or manufacturer selling goods, if I am a service provider, or if I am earning money by the way of interest, royalties, etc., ICDS now differentiates between them. So let's first have a look at the summary, what revenue recognition says. So ICDS, he says 4, deals with revenue recognition. Basis of recognizing of revenue. When do I take revenue into consideration? When I make a sale of goods, do I take it immediately? When I make a sale of services? So he says, arising in the course of ordinary activities of a person from sale of goods, rendering of services, the use by others of your resources yielding interest, royalties or dividends. Revenue is the gross inflow of cash, receivables or other consideration arising in the course of ordinary activities of a person from sale of goods, rendering of services or from use by others of your resources. So revenue is divided into 3 parts: sale of goods, sale of services and royalty, interest and dividends. He says in an agency relationship, first of all, if I am selling goods for 100 crore on behalf of the principal, my commission is only 10 crore. How much is my revenue? 100 or 10? I think this we already know, it is 10. So the revenue is the amount of commission and not the gross inflow of cash, receivables or other consideration. Now, the ICDS contains a provision that where revenue is from sale of goods, it could be recognized when there is a reasonable certainty of its ultimate collection. So when you make a sale and maybe immediately after sale, it is not likely that you will recover it, you may not take it as part of your revenue. However, reasonable certainty for ultimate collection, and this is the point important, is not a criteria for recognition of revenue from rendering of services or use by other of persons resource yielding royalties or dividend. Now this becomes an important point. How is it important? Let's have a look again at the differences between ICDS and AS. He says AS9 requires recognition of revenue only if no significant uncertainty exists regarding the amount of consideration that will be derived from sale of goods, rendering of services or by use. So AS9 does not differentiate between sale of goods, services and dividend, interest and royalty. However, ICDS says revenue from sale of goods to be recognized when there is reasonable certainty, but the words reasonable certainty are absent from sale of services and interest, dividend and royalty, which means once services are provided, the money has to be taken as revenue. Interest is accrued, it has to be taken as revenue, whether there is a likelihood of it being received or not. Now this will make a lot of difference, as I was just explaining, in the recognition of interest on sticky loans and NPAs. So we say, however, reasonable certainty for ultimate collection is not a criteria for recognition of revenue from rendering of services or use by other persons' resources yielding interest, royalties or dividends. By implication, revenue recognition cannot be postponed in cases of uncertainty regarding collectability of consideration to be derived for rendering of services or used by others for this. So this becomes important. Now, how does this override a judgment? So he says, in this regard, ICDS 4 is also in deviation from Supreme Court ruling in UCO Bank versus CIT, where it was held that interest on sticky loans would not accrue if the same was not recoverable, and Delhi High Court ruling in DIT versus Brahmaputra Capital Financial Services Limited, where it was held that interest on NPAs which is not received with no possibility of recovery may not be recognized. All this now goes. Well, it's going to add to the tax liability of these people there, as it is under stress of not recovering the money or the interest. But interest due is now going to be part of income on which tax is going to be levied, and later when it is not recovered, you can claim it as bad debt. Recognition of revenue from service transactions. He says AS9 permits revenue from services transactions to be recognized as services performed, either by the proportionate completion method or by the completed service contract method, whichever relates to the revenue to the work completed. ICDS 4 requires the revenue from service transactions to be recognized only on the basis of percentage completion method, which may however not be appropriate in case of all service transactions. For example, in case of courier services, revenue is recognized only when goods are delivered at the specified destination. The ICDS 4 is not in line with the Madras High Court ruling in CIT vs. Coral Electronics Private Limited, where it was held that the amount received as service charges for services to be rendered in future could not be considered as incurred and was not chargeable to tax. It is only when the service is done does assessee have a right over the amount that was deposited. Till then, he has no right over the same. Hence, it cannot be considered as income. Now, this will go that once amount is received as per percentage of completion method, the revenue will have to be recognized even if there is no reasonable certainty of it being received. Now, in section 3617, and you must listen to me carefully, in section 3617, there was this requirement that a deduction for bad debts can only be claimed under 3617 if the bad debts has been written off in your books. Now, if I have a look, as per AS 9, interest on NPS will not be taken as revenue. But as per ICDS, it will be taken as revenue. Now, if it is going to be taken as revenue here, and tomorrow there is a bad debt, I will need to claim it as a deduction under 3617. Now, if I want to claim it as a deduction, then I need to write it off in my books. But to write it off in my books, I should have taken it as part of income in my books of accounts, which I haven't. So ultimately, I will not be able to write it off under business ed because of the difference between ICDS and accounting standard. So no longer is this requirement necessary because we have our own standards. So write off in the books of accounts is no longer a condition for writing off bad debts under 3617. The amendment says that if income has been taken into consideration, as per any of the clauses of ICDS 4, then you can claim it as part of bad debts in case it is not recovered, even if you've not written it off in your books of accounts.